So first, I want to thank you all for coming out today. Very much appreciate you supporting the educational programming here at TwispWorks, and happy to be a part of that programming. We're going to be talking about building financial projections today, and just want to start by saying everything that I present here today is available to you. I'm happy to send files if you would find them beneficial to have in your repertoire. And certainly welcome, after the fact, any positive or constructive feedback. Always trying to improve the content of what I teach, and to the extent that there are things people wanted greater focus or greater emphasis, or things that were unclear, certainly would want to hear about that so that we can improve this programming kind of going forward. So the first thing I want to do is start with a little story, and then we'll get into the content. So when I was much younger than I am now, I got an allowance. And really my allowance was driven by the fact I had to do things, right? That's what you would expect. Mow lawns, shovel walkways, weed the garden. But during the shoulder seasons, when there was no grass to mow or snow to move, my dad would say, to earn your allowance, you need to teach me something. So I gave lectures as a young child. Now, this was before the internet. So everything I taught my dad, I probably read off the back of a cereal box. But he would always say to me, before I started, I would always be eager to dive into the content. He'd say, slow down. Who are you and why should I care, right? So I want to start with that a little bit. So my day job, is as an investment banker. The simplest way to think about what investment bankers do, we're real estate agents for companies. We help finance businesses, we help sell companies. And as part of my job, I interact with hundreds of companies every year, and pretty much all of them have financial models. And you do that over a long period of time, and you see a lot of financial models. And in doing so, you see patterns about what works, what doesn't work, how to simplify things, where you need complexity. So the goal today is, I've tried to bring to bear a lot of the lessons I've learned over time in a really simple, easy to digest fashion. So I've taken the things that I think are of paramount importance, and I've drawn them out here. And then we're going to go through an example. I made up a company called the Snowplow Company, and I've got an actual financial model that I built to support that. And so we'll go through the content, we'll go through the model, we can stress test the model, if we so desire at the end. Encourage this to be interactive. If you have questions along the way, I'd be happy to field them, in process. Make sense? Awesome. So why do we care about financial modeling? The first thing I thought about, against this question was, you should always want to know, if you're starting a business or you're running a business, under what conditions you're going to make money and under what conditions you're going to lose money. And so financial modeling is an important tool to help you assess the circumstances under which you'll be profitable and under which you will be unprofitable. And that allows you to make managerial decisions, recruiting resources, assessing your risk tolerance, evaluating your personal objectives. And so it can be a really valuable tool, not only in going out and soliciting investors, but also in helping you think about, how to manage and improve your business. Third is, financial modeling can be a really powerful tool for helping you assess how much capital, do I need to get a business started, and then to continue to fund the business over time and support it. And so financial modeling can certainly be an external tool, but it also can be a very valuable internal tool in helping you think about, capital planning. Because ultimately you're going to have to recruit that capital, and recruiting capital is not something that happens overnight. And so being aware of your capital needs and the timing of those capital needs can then enable you to enact strategies that allow you to go, get that capital to support your business if they don't come, internally from the company. Financial projections, are also very important for recruiting capital from banks. If you're ultimately going to go get a loan for something, a bank is going to want to see some financial projections. If you are going to solicit equity capital, whether it's from the min or from other sources, quite standard that somebody is going to want to look at some base level financial projections to really assess the risk that they would be taking. Because once they understand the risk, they can then determine what's the appropriate cost of that capital, right? Low risk capital like debt, lower costs, higher risk capital like equity, expecting a higher return, and therefore a higher cost of capital. Lastly, I encourage people, who undertake, financial modeling to maintain those sets of projections and to update them from time to time. And to the extent that things have evolved in a way that's different than anticipated, it's really good to look back and say, what was I thinking at the time? What actually happened? And then that gives you a basis for how to think about improving your financial model over time, which will then make it a more valuable tool to you. So a disclaimer about financial modeling. So the first is financial projections are wrong 100% of the time. We cannot project into the future in business with a tremendous degree of certainty. While we would like to, the practical reality is things will evolve, different over time than we were thinking when we put them together. And that is first because many variables, especially those tied to revenue, are hard to predict with a high degree of accuracy. Meg doesn't know how many people are going to walk in the door of Blue Star each day. She's got a sense of the range, but precisely predicting, very, very difficult. Secondly, there will invariably be unanticipated expenses with the operation of your business. Things break, things cost more, you forgot you needed something, you might need to hire somebody additional to deliver your product or service. And it's always the case that what you think about cost when you model at the outset will change up or down over time, which will, again, change your financial model. Third is things will happen that impact your business that you can't predict today. Pandemics. I don't think anybody could have predicted the pandemic. I don't think anybody models pandemics. Weather, personal health, family issues, good or bad. Very hard to predict, the future around those types of things. And then lastly, when you're operating in a business environment, you accept a certain level of, dynamic reality, right? Business cycles, economic conditions, do impact, companies. And as a result, they're really hard to predict. And invariably, what you assume going in is unlikely to be what you experience, especially as you do it over a longer period of time. But that does not, invalidate the importance, for a financial model. It's always good to have a baseline, right? Even if the baseline is wrong, because it informs, what you expected. And then, secondly, financial models, they're all based on assumptions, right? And it's the quality of the assumptions that determine whether a model, is a good model, or a less constructive model. And you can use models to test various assumptions. And when we go into my example, we can test some assumptions and see how it impacts our revenue, how it impacts our profitability. And then, as I stated, models can be updated, as things that we previously assumed become certain, right? And again, that will enable you to have a more effective and leverageable financial model, over time. Lastly, there is a propensity of people building financial models to overcomplicate things. Complexity in many cases is interesting, but not useful. And so as you think about a financial model and building a financial model, you want to find the right balance between, accuracy, and complexity. And I encourage people not to pursue complexity for complexity's sake. I had a potential client, contact us about looking at their business, and their financial model had 164 tabs, which is the biggest financial model I've ever seen. And before we spend time evaluating a business, we have a committee meeting. And I said, we should just not get involved here. And my partner said, why? I said, we're going to waste all this time going through 164 tabs. And we know this is not an accurate financial model. So the investment of time relative to the benefit of doing that work, didn't make sense. So really important to keep these in mind, as we go through this. So the first thing I want to dive into as it relates to financial modeling details is really the issue of an accounting basis. So there's two ways to do accounting. One, which is the most common way for small businesses, is called cash-based accounting. The other is called accrual. And knowing the difference is exceedingly important because it will impact how you look at your business. So cash accounting, again, fairly standard for small businesses. It's really easy to understand and execute. And basically all it is when you get $1, you book $1 of revenue. When you spend $1, you book $1 of expense. But it also makes it hard to understand your actual operating margin of your business, which again then can complicate how you think about profit and loss, and investment, right? Let's take an example on campus, Equipped, right? Equipped used to be on cash accounting. And Jonathan would look at the business and said, I don't make as much money as I thought I would. I said, well, Jonathan, your model doesn't actually tell you all that much because you might buy a ream of fabric and you book that expense, but you sell those bags over the course of 6, 9, 12 months. And so I don't think you really have an understanding of your profit model because you are on cash-based accounting. So that's a really good example, raw materials inventory, of how cash accounting, can in fact be an Achilles heel in thinking about profit and loss for your business. The second is accrual accounting. So accrual accounting is basically, it's a matching principle. So you recognize revenue in the period in which it was realized, and you match the expense, with the revenue. So in the case of Equipped, if it was on accrual accounting, when they sold that bag, they would recognize the expense of building that bag and the materials and machine time that went into it, at that point of sale. And the net result is you have a more accurate basis for understanding and assessing, financial performance. That said, it certainly takes some acumen, especially around, fundamental accounting principles. And most people who are using accrual accounting are working with an outside accountant or have developed, the knowledge internally to apply those principles. It very much is the case that you can do a hybrid of them. You can be on cash accounting for certain things, and you can be on accrual accounting for certain things, and you can get the benefits of both without jumping all the way into the accrual pool. And recognize that, how you account and how you pay taxes don't have to match. So you can have a way of accounting for your business, revenue, profit, and loss that informs how you manage, the business. And that can be different than, how you in fact, calculate your income for tax purposes. And we'll go into a little bit of those variances, as we go along. But it's really important to start by picking what your accounting basis is and understand the application of that accounting basis in your financial model, and both the benefits of it, and the limitations in utilizing it. So the second topic I want to talk about within financial modeling is the concept of cost accounting. So cost accounting is where the biggest mistakes are made in financial models. So let's go through some financial definitions. So gross margin is a measure of financial performance that's calculated by taking the difference between the revenue and all the costs directly attributable to generating that revenue. It's an important financial calculation because what it tells you is after you have built the product or delivered the service, that will tell you how much money you then have available to fund all your operations, which is your salaries, your rent, your utilities, whatever it is that makes your business go around that isn't directly attributable to the product and service. And therefore, it's of critical importance to making pricing decisions and projecting the profitability and sustainability of a business over time. So one of the most common mistakes people make in estimating gross margin is failing to capture the non-obvious costs of making a good or delivering a service. And they're conflating what's called product margin, with gross margin. So product margin is very simply, the revenue minus, the costs, right? Like if I'm making a pizza, right? It's the cost of the dough, it's the cost of the toppings, right? But the reality is there are non-obvious costs that I have to incur to make that pizza. There's oven time, there's labor, there's utilities to power the ovens. And so it's important in thinking about your margin profile to take into account both the obvious costs and the non-obvious costs. Because if you don't take the non-obvious costs into account, you may believe that you are selling a product or delivering a service that is profitable when in fact it isn't profitable. And therefore, you may actually be running an unsustainable business. Where if in fact you do a good job of fully accounting for the costs to make a product or deliver a service, it can then better help you, think about pricing and sustainability, and again, estimating profit. So cost accounting is the discipline utilized to estimate and apply all costs to an individual unit of product or service such that margin can be most accurately measured. So to the extent you delve into understanding financial accounting, it's also important that you delve into cost accounting because it's an important aspect in thinking about pricing decisions, manufacturing throughput, that ultimately then will go into thinking about your financial model. Another thing that's worth talking about is the concept of depreciation. So depreciation is how you allocate cost of a tangible or physical asset over its useful life. Whether you use cash accounting or accrual accounting, you can subtract depreciation to reduce taxable income. And then, so here's where tax accounting and financial projections and financial accounting all come together. So every tangible asset has a useful life, after which it has no value for accounting purposes. And in practice, it likely needs to be replaced. So the IRS, defines the useful life for various assets. So most commonly, that life is between 5 to 7 years. But in some cases, land, real estate, it can in fact be up to, I think, like 35 years. So when you model your income statement, you do want to take into account depreciation because you want to be able to assess the extent to which, once an asset needs to be replaced, you have sufficient resources to, in fact, finance that purchase, or where to go to finance that purchase. While depreciation is technically a non-cash charge, because you've likely bought something, right, like a truck, right, the application provides a better representation of the business cash flow potential, and ultimately, cash flow is what everybody cares about because it's how you fund your business over time. And so in my example, I'll go through depreciation specifically. I've built that into the example because I think it'll be useful for you guys to see. So my made-up example is called the Snowplow Company. So the Snowplow Company is a company I've formed to deliver snowplow service to the lower valley. So Bethel, Carlton, and Pateros. Our motto is great rates, reliable service. And I'm going to tell you about my company. So I'm forming the Snowplow Company as a project because I believe that area is not well serviced by any of the snowplow providers in the valley. So I see an opportunity, and I want to start a business, and I want another source of income, to support my family, and I love plowing roads. So this feels like it's really perfect for me. We are going to offer two types of service. The first is continual service. So every 6 inches of snow that falls, if you are on our continuous service program, I will come plow your driveway. Additionally, I will offer on-demand service. So you can call me up and say, hey, can you come plow my driveway? And when when we have capacity available, we will come do that. So continual service is sold at a price of $50 per service, regardless of the length of the driveway, the complexity, or the time it takes. We're just one size fits all. If you want us to plow your driveway every time it snows 6 inches, $50. Great deal. You guys should all be running to the snowplow company. On-demand service, however, will be between $50 and $100. And we'll price it based on the length of the driveway, the complexity, or how long it takes us. So two types of service. So in thinking about actually making this actionable, I need to do a number of things. One is I need to buy some trucks, right? Can't plow snow if I don't have vehicles, and I'm going to need a couple of snow plows, on those trucks. I'm happy to drive. I love driving. My dog loves sitting in the front of the truck, so he and I will drive one truck, but I got to hire an experienced driver and pay them an hourly wage. And that's my biggest fear, is finding labor to support my business. But I think I'm going to offer a pretty competitive rate, so I'm optimistic that somebody will want to work with me. I'm not really good at managing billing and collections, so I'm going to outsource that to somebody else. I'm going to pay somebody to do my billing. I'm going to pay them to chase, people who owe me money. And hopefully that will simplify my life and free me up to do more of the plowing myself. Nobody knows me. I just moved here. Haven't plowed many people's driveways, so probably need to invest in some advertising to recruit customers. And I'm going to need some capital to fund my operation. That's fuel. I'm probably going to have to repair my trucks, maintain, the snow plows, and a couple other things I'll probably want to have around. And so I'm going to build a financial model to figure out whether this is a good idea or a bad idea. And if it's a good idea, I'm going to then think about, okay, how do I fund this? And based on that, I'm going to make an offer to somebody to become my financial partner. So in order to do that, I really need to do 4 things. One, I need to build an estimate of revenue. So I need to estimate demand, and I'll show you how I've estimated demand. And I need to think about my pricing model over time, because revenue in a snowplow business is price times quantity. It's as simple as it gets. Secondly, then I need to figure out what the cost structure of my business is. I need to think about wages and wages over time, and fuel cost over time. And then I need to estimate my operating expenses that are not involved in delivering the service by billing, my collections, et cetera, et cetera. So I'm really going to focus on putting together an income statement. And I'm going to focus on 2 measurements. Gross profit, right? Because that's going to tell me how much money I'm making from delivering my service, and therefore how much cash I have available to fund my operations. And I'm really interested in my operating income, which is my cash available after operating expenses, because these trucks aren't going to last forever. And I don't want to do this for a couple of years. So I've got to make sure that when I get to the other side of the useful life of these trucks, that I can buy a new truck, right? So I also want to assess the extent to which this might be an attractive investment for somebody to come in. So I'm building this financial model to determine whether I can attract outside investors. I'm also going to do a stress test on the model to see, what could go wrong and how that impacts whether this is a good idea or a bad idea. So I built this financial model. You'll see things are black and they're blue. So financial modeling trickery requires a little bit of color coding. So where I've made an assumption and hard-coded a number, I've put it in blue. And therefore, where there's a calculation that is done by the model, I've done it in black. And this then will help me as I think through assumptions and change assumptions. I want to really be thinking through the things that are in blue. And if I change something in blue, it should change other aspects of the financial model. So the first thing I'm going to do is think about what are my capital needs. So the snowplow company, as I said, there's going to be 2 drivers. We need 2 trucks. 2 people can't drive 1 truck at the same time. I've been following trucks on, Car Guru. I think I can get a really high-quality used truck for about $50,000. Haven't seen many good used snowplows online, so I'm going to buy new. And I've been pricing out models, and the plows I like are $3,500 per. And so my business is going to require $107,000 to get started, right? That's 2 trucks, $50,000 per truck, plus $7,000 for my price per plow. Additionally, I need some working capital, right? I'm going to have to pay, my other driver and pay for maintenance and fuel before I collect the revenue. So I need some money in the business to make the world go round. And so I've estimated that I need $5,000. So that is a total capital requirement of $112,000. Now, here, I'm going to assume my depreciable life of my trucks and my plows is 5 years, which means that my annual depreciation expense that I'm going to have to realize is $22,400. That's just my 107, divided by 5, right? And if I'm taking into account depreciation expense, I can look at my profit and say, after 5 years, am I going to be able to buy a new truck, right? If not, I probably need to think about, changing my business in some way to make it more sustainable. Because again, I don't want to operate this for 5 years and then go do something else. I'm probably at the point where I don't have any better ideas than this.
So is that the rough formula, like the amount of the asset divided by its lifespan?
By its useful life, yes.
By its useful life.
Correct.
Equals the annual depreciation.
Yeah, exactly.
I have a question. How do you, when you're looking at working capital, is there a percentage of your hard capital that you're looking at to say, this is how much I should have in my business?
So the sophisticated answer would be that you look at other businesses and you assess your business model versus theirs. You look at how much working capital there is, and you use that as a percentage of revenue. So what is working capital? It is the liquid, assets minus the current assets, current liabilities, right? And it's really going to be dependent upon your billing cycle, right? So to the extent that you deliver a product or service and somebody pays you 60, 90, 120 days later versus I go to Blue Star, I get a cup of coffee, and I give them that money, much less working capital required in the business, under that circumstance, except there's roasting and things like that have to go into it. But it's really tied to what's your revenue receivable cycle, how much inventory, do you need? I'm just assuming that a business like this, if I need more than $5,000, I'm probably, doing something wrong. But you really want to look at what other people are doing, as an estimate. And it's better to have more resources available should you need more working capital. So now that I know how much money I need, I'm going to get to my revenue assumptions. And so I've done a 4-year revenue build here, okay? And This is a really common way of doing revenue assumptions, which is what's called an addressable market scenario. So what I've done is I've estimated, based on sophisticated analysis where I've counted all the houses in Terrace, Carlton, and Methau, that there are 1,000 homes in that area that have driveways. And my belief is some people are going to plow their own driveways. Some people already have somebody who does it, and they won't want to do business with me. But I believe that I can get 33% of the market, right? So that's 330 homes that are available, that'll be open to hearing my pitch about plowing their driveways, either on a continuous basis or a one-off basis. At the same time, I still don't think all of those people will want to work with me. So I've made an assumption that 30% of them will, in fact, come on to be my customers, which basically means that I have 99 customers. So that's 1,000 times 0.33 gives me 330, times 30 gives me 99. The next thing I have to do is say, okay, if I have close to 100 customers, how many times am I going to plow their driveways a year? And I've estimated, in looking at really, really sophisticated weather data, that on average over the last 10 years, there are 20 snow events in this area of 6 inches or more during a season. And so taking my 99 customers by 20 services means that I basically got to plow 2,000 driveways to deliver my service. So I assume my continual service of $50. I'm going to probably assume my price increases of 10%. I'm going to assume that, 20% of I'll really do a great job. So people are going to say, hey, if you don't plow with the snowplow company, you probably should think about that, right? So I'm really relying on word of mouth and my advertising to enable me to grow my customer base 20% each year. At the same time, I also understand not everybody's going to love, what we do, right? Maybe I'm going to hit somebody's deck or forget to plow their driveway, and they're going to say, I'm done with you. So I'm going to assume that 5% of my customers leave every year. So that's what's called customer churn. So in order to estimate my revenue, and just for clarity, I'm really doing this both separately, continuous service from on-demand service. So I start with my 99 customers in year one. I don't add any new customers. I don't lose any customers. And so I end the year with 99 customers. Over the course of the year, I have an average of 50 customers, and I have 20 service events, and I charge $50 per service. And so my first year revenue, I'm estimating to be $50,000 for my continual service. Not bad, not bad. Haven't thought about what it's going to cost me to do that, but hey, I got $50,000 in my pocket, right? And what I've done for the purpose of future years is I've said, okay, if I start the year with 99 customers, I add new customers, right? That's 20. So that's my customer growth of 20% times my 99, rounded up for conservatism. And then, my churn. So I'm going to lose five customers a year. And so I'm going to end the year at 114 customers. So again, over the course of the year, I've got 57 customers. And I have 20 service events. I've increased my prices 10%. So $55 a service. Hey, I'm going to make $62,700 in my second year. It's pretty good, growth. And I carry that to year 4, where I'm making about $100,000. So my continuous service revenue basically doubles over a 4-year period. So pretty nice growth. Going through the estimation model, of continual service, I'm excited. I'm pretty pumped about this. Now, I also think that there's going to be, these on-demand customers. Maybe they want me to plow when there's less snowfall because they've got a family event, or maybe people will just call me on a one-off basis. I think that there'll be 100 service events every year that are on demand. People just calling up and saying, hey, I normally plow my own driveway, but my truck's broken, or I'm not in town, or special service. I'm going to assume that I charge $75 per service event, and so making about $7,500, and basically keeping that constant, right? So I'm growing my charge per continual service customer, but keeping this constant, just again to be conservative. And so I take my continual service revenue and my on-demand service revenue, and that gives me my revenue for the year, right? Pretty simple business, right? Revenue times quantity, frequency being the most important thing. So now that I've estimated revenue, what I want to do is come back and say, okay, if this is my revenue, does it make any money? And then once we do that, we can come back to looking at some of these assumptions and seeing how they impact the viability of my business. So let's go down to the cost build. So in building up cost, the first thing I had to think about was labor, right? If I can't find somebody to deliver the service, I'm not in a good spot, and I'm going to have to pay somebody to do that. So for cost purposes, I've got 2 drivers, me and the person I hire. We assume that we're going to work 40 days, throughout the year delivering the service. Those days that we work are going to be 10-hour days, right? We're going to be doing a lot of driving, but we're going to be in these neighborhoods, so we want to plow as many of them as we can, on a given day. And I'm going to offer my employee $30 an hour. So basically what that equates to is I need annual wages of $24,000, right? And I'm going to assume that every year that I'm going to have to increase the amount that I pay on an hourly basis to my driving partner and to myself. So I'm assuming wage inflation of 5% year over year. Secondly, I have to think about gas. My God, gas is a headache, right? It's every time you think it's going to go below $5, it goes back up. I got 2 trucks. The trucks that I've looked at, they get 15 miles to the gallon in the winter. Not great, but not terrible. My assumption is over the course of a day, a 10-hour day, we're going to drive 100 miles per delivering the service. And that means I need about 7 gallons of gas in order to support a day of delivering the service. For the purpose of my cost build, I'm going to assume that gas costs $5. And that essentially means that's $67 per day per truck in gas. So 67 times 40 basically means I've got $2,667 of gas expense to deliver the service. Unfortunately, trucks break, right? And the longer you drive trucks, you need maintenance and service. So have to factor in, that I'm going to have to spend some money making, the trucks viable for delivering the service. So I assume 1 annual service, that's $500 per. And I'm going to need 2 oil changes per truck. And an oil change, I'm assuming, is $75 because that's what I paid last time at 509 Automotive to get my oil change. So my total service costs per year is $1,300. I'm also going to make some assumptions about other vehicle costs, which I've estimated here at $2,000. This is my insurance. If I get into a fender bender, I'm going to have to fix it. Maybe I need to get a flat tire, need a new tire. So just for conservatism, I'm going to assume that every year I'm going to have to put an additional $2,000 into the trucks to keep them working. And so I've taken my gas cost plus my service cost plus my other costs, and that gives me a total vehicle cost for the year of about $6,000. And for the purpose of my cost assumptions, I'm going to say that's going to grow with inflation, right? If my wages are growing at 5%, I assume the cost of my service is going up 5%. So then I put together my cost bill. So I start with wages, right? So here are my wages, right? $24,000. They grow 5% each year. So really excited about the wage aspect of my business, because my revenue gets a lot of leverage, but my wages don't grow as much. So excited about that. Here are my vehicles. This is my fuel. This is my maintenance. I'm going to spend $500 in advertising in my first year. But I think it's going to go gangbusters, and after that, I'll probably have to start turning customers away. But I'm going to have to pay somebody to do my billing. So I basically estimated my billing as a percentage of revenue, and I'm going to pay about $3,000 a year for billing, which is 3% of revenue. And that will obviously grow with my revenue. And I plan to take credit cards, so need to pay for those credit card charges. So now I take these two things and I bring them together in an income statement, which again is the most important thing in thinking about financial projections, because it's going to tell you, again, how much capital do I have available to fund operating expenses, and then does my business make money? And then third, does my business make enough money to be self-sustaining? So here's my revenue, again, from above. And here's my cost of service. That's my wages. That's my vehicle maintenance, plus my fuel. And that gives me a gross profit margin, for my business. And I've calculated that by taking gross profit and dividing it by total revenue, and that's the percentage here. And so I estimate my business will grow from a gross profit of 54% to 70%. And I've looked at a number of services companies, and I know that 70% gross margin in delivering a service, for this type of business is really, really good. So it looks like I can, if everything works out, this will be a nice business, in 4 years. So then I total up my operating expenses. I've got my advertising expense. I've got my cost of billing. I've got my other vehicle costs. This is my maintenance and my other. And that gives me total operating expenses that are summed there. And so I calculate my operating profit by taking my gross profit and subtracting from it my operating expenses. And basically, my operating profit is $24,000 in the first year and grows to $67,000 in year 4. So pretty nice business. That's an operating profit margin of 42%, growing to 63%. So really, really high operating margin business. Essentially, the term we use for that is there's a tremendous amount of operating leverage. We're taking a small amount of assets and we're deploying them repeatably to produce revenue. Now, one of the things I was, sort of concerned about is, do I have enough money, at the end of this to, in fact, buy new trucks? So here's my depreciation expense, which gives me my taxable income. And remember, it cost me $50,000, to buy those trucks. And so what I've done is I've just added up over time the cumulative operating profit and the cumulative taxable income. And lo and behold, if this project works out, between year 3 and year 4, I should have saved enough money where I can go out and add a third truck or buy new trucks. So I feel pretty comfortable in this business model working, right? So now let's talk about what could go terribly wrong and how that impacts my financial projections.
Sorry, could you just repeat what you just said about depreciation? Is part of the reason that you're keeping track of that for taxes?
So for tax purposes, yes, you get to take out depreciation.
Okay.
And the truth of the matter is, depending upon how you're organized, you can in fact have different depreciation methods.
Okay.
So and this is probably going down a rabbit hole, but one of the reasons that people select what's called an S corporation for how they incorporate their business, it allows accelerated depreciation for tax purposes.
Oh, interesting.
But why I'm doing depreciation, why I really care about it, is I want to make sure that I can then buy new trucks when I need new trucks to continue to have this business. Because if I ended up out here, year 4 and I had $30,000, I would say I either need to raise prices or I need to find more customers, or maybe I shouldn't do this business, right?
So what would that come out of in this model in year 4? Cumulative.
Cumulative taxable income.
Okay. And that's what you're making sure. Another 50 grand.
Exactly, after I pay taxes. So let's now show the fragility of financial models. So unfortunately, I started this business and I bought the trucks. But you know what happened the first year? It didn't really snow. And as a result, I only had 10 plow events per year. So if we just change that one assumption, what happens to my business? I go from making money to never making money.
But that's saying that's going to be bad snow year for the next 4 years in a row.
Correct. But it is worth me looking at the possibility of that happening. Now, 1 year, I got to be ready to do this, right? It could then go back up, and I could wire this to have separate, event counts over time. But the key point is, with the changing of one assumption, 50% of what I thought I would deliver in services, that's going to take me from a profitable business down to an unprofitable business. So I basically have a $45,000 swing in profitability. Now let's go back up here and assume that while it does snow, it's just the case that people are just not interested in outsourcing their service to a new plow service. So I've taken down my 30% of customers acquired down to 10%. What happens? It's even worse. So think about, also the prospect of maybe I do acquire more customers, maybe it does snow a little bit more, but that hybrid where it doesn't snow as much as I had assumed, or I don't have enough customer acquisition. Again, this business can go from profitable to unprofitable very quickly. So before I go out and buy those trucks or think about taking on a financial partner, I got to be pretty certain that I can acquire the percentage of customers that I think I can. And I have to be pretty confident that even in an average year, 20 plow events, will be highly likely. And so it may be the case that in order to de-risk this, I'll go out and I'll do a survey. I'll go door to door and I'll knock on 100 doors and I'll say, do you plow your driveway? If not, who does? How happy are you with your service? How, if I offered to plow your driveway for $50, would that be interesting to you? So I might go out there and do some research and assess the extent to which my service is going to resonate with customers.
But you would also account for if you had less customers, that you would have less fuel, less maintenance.
Correct.
I mean, you would adjust those other.
Yeah. So the way this model works is if I change the plowing events, and I change the customers, it automatically changes the number of services I deliver, right? Which then changes how much gas I use. Right? I'm still assuming that gas is going to be $5, but I'm going to use, less of it. But the point being is, and Meg is a great testament to this. Service businesses are very, very fragile, right? When it's good, it's really good. When it's bad, it's really bad. So, this is a risky proposition. While I can come up with some, I think, reasonable assumptions, and if all of them, come out to be true, I have a nice business. But if even one of them or a cumulative, couple of them don't turn out the way I think that they will by a significant margin, I'm going to have problems. And so I need to go into this venture and assess my risk tolerance, which is, okay, what happens if year one it doesn't snow and I got to absorb $25,000 worth of cost, right? And again, this is a useful tool in helping me think about how much capital do I need to plan for, or what do I have to believe, has to go right, and if it doesn't go right, what's the impact of it, right? So building a financial model and clearly elucidating the assumptions and then being able to manipulate the assumptions really then is helpful in seeing various outcomes of financial performance. And then you can ask yourself, okay, can I sleep at night, or not, thinking about, is it going to snow or not, right?
So if you'd be bringing this to an investment group, it would help to show that you have assessed the risk.
Yeah, exactly. So what I would normally do if I was going to be, take this to an investor presentation, I would say, okay, the key risks here are how much is it going to snow and how many customers I'll acquire. I'm pretty confident about the customers acquired because I've gone out and I've knocked on hundreds of doors and people tell me they're looking for somebody to do this, right? On the snow things, I could say, I've assessed, over time, but, we're never going to know, right? Until, we look back over time, right? And so I might say, I might plan for a longer period of time, before I return investor capital. So if I was taking out a loan, I wouldn't feel confident paying it back in 3 years, right? But I might feel confident I could pull this out a couple more years. I might feel confident, 5 years. And your point is absolutely the right point, which is if you're building a good financial model, you're not going to drive it off of one set of assumptions over time. You'd have assumptions each year, right? And the year's, financial model, revenue, and cost would be based on the assumptions. So it could change assumptions year to year and have it only affect that year. But the key point is you should build a financial model that clearly elucidates your assumptions, and then you should stress test the assumptions to understand the key risk points. And then you should come up with strategies to assess those risks and, think through concepts about how to mitigate those risks if you can, right? Any other questions?
Just kind of going back to when you were talking about figuring out your operating capital, and you said that you try and look at other businesses and find similar ones. Do you have any thoughts on where to go for something like that, or how to do that sort of research?
Yeah. So there's a couple of ways that I would go about it. One, Chamber of Commerce is a great place to meet and network with other businesses. And ideally, you would seek to meet, members of the business community and approach them and say, hey, I'm thinking about starting a business. I'm thinking about my working capital requirements. My business is similar to yours. How do you think about, working capital? I don't advocate or I don't, suggest going out and saying, how much revenue do you make? How much profit do you make? How much working capital do you have in your business? That's more likely than not going to get an adverse reaction. But if you approach people in the right way in a business community that is nurturing and supportive, and I find most people who come to Chamber of Commerce meetings, tend to be engaged in growing the business community. People will be thoughtful about what they're willing to tell you. There's publicly available information. They're not going to be similar size businesses, but you can look at public companies and see how much working capital they have. To be honest, is really, really much more important in a product-oriented business, right? Because that's where you're going to have inventory. And inventory is where you're going to tie up capital more than, any other place. Again, you could also build a working capital model, right? I mean, this is an income statement. The ideal would be to build an income statement and do a balance sheet and then a statement of cash flows and do that over time. And then you could use that balance sheet information to estimate your working capital requirements. But it really is going to come down to what is your cash conversion cycle. When you have an expense, how quickly are you bringing in revenue, to offset that. And I've specifically gone into a service business because I hate working capital. Anybody want to see any other assumptions change? And how badly that dents my business?
How about what if things go very, very well?
Oh,
Is that the idea?
really good question. So the truth of the matter is it will break the model, but it won't break the model, right? So if I say, I'm going to get 50% of the customers, the addressable, or I'm going to get half the customers, and it's...
If you got half the customers, would you still be able to cover that with 2
No,
drivers?
that's the answer, right? So then I'm going to look at my model, I'm like, oh my gosh, I go from 2,700 to 5,000, and I should be able to look at that and be like, I can't do that with 2 drivers, right? So then I would update my financial model. I'd say, okay, what happens if, right, I get 3 trucks, 3 snowplows, I need 160,000, I need more working capital in the business, and I need to update my cost assumptions because I need 3 drivers, my trucks work. So interestingly enough, I'm making more money, but it's maybe going gangbusters is not the strategy. I'd rather go gangbusters and stick with my 2 drivers and serve my third of the market. I make more money, but this is too much risk for me.
And you're dealing with employees.
Exactly.
Where is it the risk? Just spell it out for us.
So the risk is up here.
Just in the capital that you need to start.
I got to spend $170,000, instead of 107, just to get this business started, to have a resource deployment to support that.
But you would weigh that against all the family.
Exactly. Well, the other thing I would then say is, okay, what if I invested this, and what if my plowing events, per year, again, let's go down to 10. What happens? That's where my mental health goes off the charts.
If you already have a truck and you're the only driver,
That's the other way to think about it. Yeah. And there's nothing wrong with that, right? I just thought if I did that, which is exactly what I would do, you guys would be bored. So I tried to add some complexity by not, adding unnecessary complexity. But yes, that's what I would do. I'd get a truck. I'd go out and I'd see if I could service the market, by myself, and could I make $25,000? And if I did that for a year, then I'd think about hiring another driver, and I probably would pay them more if they had a truck. They could use their own truck, but instead of paying them $30, I'd pay them $50. And again, that's how I would de-risk the situation, and I may not get the reward, right? Commensurate with the risk I'm taking. But it would certainly lower my stress level of having to front $107,000 of my money or somebody else's money to get this business, started. But I did the logo myself, so I'm not out of pocket. Very deep at the outset. So, any just questions you guys have about financial modeling and, even your business or your business idea and, issues to think about or questions you have or, concerns. And I want to also offer, I live here. I love sharing knowledge. If you're thinking about building a financial model and you want 30 minutes of time at the outset just to get it set up right, or how do I do things in Excel, or how would you estimate this? I'm happy to spend the time with you. If you have questions, I'd love to be helpful in answering them. If in fact you would find that valuable. So.
Yeah, I guess, the thing that I just would love to add is that I've had a number of small businesses, and I think the most important thing I've learned over time, it didn't take me long to learn this, is that the first person I always hire is a bookkeeper, a really good bookkeeper. But before that, I work with an accountant to build this, because that's not my area of expertise. I'm not an accountant, and it's just the most valuable thing you can do.
So I'm married to a pastry chef. She syncopates like this. The thing that broke my marriage first, before anything else, was trying to teach her cost accounting. She's like, "What are you talking about? It's just the price I pay. Someone pays for pickles, minus the cost of the jars and the pickles and the spices." I'm like, "What about your time? Your time has to be worth something." So it's certainly the case that there's a lot of online resources. There's a lot of good business resources in the community. Bookkeepers can be a tremendous resource in thinking about and analyzing financial models.
Would you suggest that here in the Met where seasonal things are crazy and everybody has a really hard time at certain times of year and then goes nuts, at other times of year, that you do month-by-month projections?
So I always recommend monthly projections for the year you're operating in, because especially for working capital purposes, because more than anything else, you got to prepare for working capital peaks and financing a business, during those peak seasons. I've specifically built an example here that is, feast or famine, sort of seasonal. It's one season and it's a short season. But if the truth of the matter is, small business is really hard to project month to month. So what I always say is, people, with greater precision, they can predict a year. It's very hard to predict a month. But you could also do quarters, and saying, oh, well, yeah, maybe it won't happen this month, but it'll happen within these 3 months. So the more you can break it down to digestible pieces that sum up to an annual total, I think the better off you are, right? You're also injecting complexity, but I think it's important complexity. But invariably, again, you're going to have challenges, of precision, because things will always be different than you anticipate.
How do you come up with the stuff in column B? Is that where, you pick the bookkeeper's brain? Is that the...
So, I think you start with saying, okay, what am I going to have to buy, right? Or what am I going to have to use to deliver the product or service? And then it's always great to just ask somebody, especially if they're in business, and say, hey, I want to bake cakes, right? I know it's going to cost for flour and yada yada. Is there something on my list that you see that I'm missing? And you can look at incomes. There's tremendous amount of public information on income statements and financial statements. You just look at similar businesses and say, okay, what does their income statement say? What are they including? But then always ask somebody, what am I forgetting, right?
So where do you go to find it?
So you can get it like Yahoo Finance.
Okay.
You can get public financing. Yeah, but you could just Google, you could even take a business and say, you could just Google product business income statement, and you'll probably get hundreds of examples. And, again, people like me, we're here to help. So if you ever say, oh, I'm trying to start this business, what should I be thinking about as my income statement? Accountant can also be very, very, helpful in getting that format right, at the outset.
Thanks.
No problem.
I have, go ahead.
No, go ahead.
I have 2 questions about depreciation. First one is, if your business model does not have any tangible
Yes.
aspects and is more ideas,
Yep.
concept sharing,
Yep.
is there any depreciation converting area?
So, if you were to get patents or trademarks, those are technically assets that have a depreciable life. But again, if you don't have hard assets, I would just ignore depreciation
Okay.
for the purpose of your initial modeling.
Okay, that makes sense. With real estate, there's depreciation and appreciation.
Yep.
So,
You only book the depreciation. You don't technically, for accounting purposes, do what's called a mark to market. Because it can appreciate and it can depreciate. It can appreciate, and you only realize the appreciation or the depreciation at the moment in time that you monetize it. So accounting does not require you to mark it up and mark it down. But the most important thing is, again, for tax reasons, you get to depreciate it, so it lowers your taxable income, which lowers the amount of taxes that you pay, right? Now, if you were to sell that property and realize a gain, right, you're going to pay a percentage of, your capital gains, long term or short term, on that. Yeah. Yeah. Yes.
I was a little late, so I might have missed this, but would you be willing to share this?
Yeah, I'll send you the spreadsheet, presentation. I'm going to fix my typo that I noticed before I send it out. But again, there's nothing proprietary here. But if I see all of you starting a snowplow business this winter, I want a 6% royalty. Just go up valley. Just don't come into my turf. Hopefully you guys have all gotten something out of this. Hopefully it's been more clarifying than it has been confusing. But I also know that, I live this, right? So it's really, easy for me to digest and understand. And it's not always the case that, when you are really intimately involved with someone, you can deliver it in layman's terms. But I hope I've done that. I've tried to do that. But to the extent that you guys have questions or I can be helpful, I'm more than happy to invest time with each of you. And appreciate, again, constructive criticism or positive feedback on the session, because I'm hoping to co-opt Patrick into doing some business financial literacy programming that extends beyond this. So really want to be a resource to help people who are interested in the MIN get through that process if that's what interests them. So thank you for your time. Have a wonderful night.